If someone handed you $100,000 today and told you to turn it into $1 million by 2030, how would you do it? Do you invest into the stock market and hope for a massive uptrend? Or do you put it into real estate and play the long game? In this video, we'll put both to the test and see which one gets closer to that million. We're going to break it all down into two lists, pros and cons of both, and by the end of this video, you'll know which one will make you close to $1 million. Let's begin. When someone tells you that they're investing into real estate, what do you think of? Most people think of owning 10 properties, receiving rent payment every month, and not having to do a single thing, right? Well, not really. Real estate includes buying rental properties, flipping houses, investing in commercial real estate, or even buying into REITs, which are real estate investment trusts. Basically a way to invest in the real estate without owning a house. But for this video, we're talking about the traditional route, buying physical property, whether to rent out or to sell for a profit. Let's go over the pros of real estate ownership. Number 1, it's a tangible asset. You own something real, something physical. You can see it, touch it, and prove it. That sense of ownership and control is something stocks cannot give you. Number 2, passive income. When you have a rental property, tenants are paying you every single month. That's cash flow coming in, often covering your mortgage and putting money in your pocket. If done right, it can eventually become completely passive. Number 3, appreciation. Over time, real estate historically goes up in value. So not only are you collecting rent, but the property itself is worth more than you bought it. That's a win-win situation. Number 4, leverage. This one is huge. In real estate, you can put down 20% and control 100% of the asset. The bank covers the rest. That means if the property goes up in value, you get all that gain, not just 20% of it. This means you can own 2 to 4 properties without paying the full price. Number 5, tax benefits. The government actually rewards real estate investors. You can deduct mortgage interest, property taxes, repairs, and something called depreciation, which lets you reduce your taxable income even while your property is going up in value. That's a powerful tax strategy. And number 6, it's an inflation hedge. When inflation rises, rent goes up, property value goes up. So your investment keeps pace with inflation and can sometimes beat it. That's something not every asset can do. Now you're probably thinking, real estate sounds too good to be true, right? Well, it sounds too good to be true because it is too good to be true. I haven't told you the full story, and I bet you will change your mind after you hear the cons of real estate. Number 1, it's not liquid. You can't sell a house in 5 minutes. When you need cash, it takes months, sometimes longer to sell. If you're in a financial crisis, selling a house to make money is going to pose a serious problem. Number 2, the entry cost is high. We're talking down payments, closing costs, inspections. You're looking at tens of thousands of dollars just to get started. Number 3, it requires active management. Tenants calling at 11 p.m. about a pipe bursting, roof needs replacement, termites in the walls. Unless you hire a property manager, which eats into your profit, you are the one dealing with all those expenses. Number 4, there's concentration risk. A huge chunk of your net worth can be tied in 1 or 2 properties in one location. If the house market in that area tanks, you will feel the full impact. And number 5, you're not guaranteed tenants. When a tenant moves out, the income stops, but the mortgage, insurance, taxes, those bills don't stop. They keep piling up, and compounding is real. Compounding isn't always a bad thing though. You can use it to your advantage in stock investing. I will show you how in a second. But let's go over some of the benefits of investing. Number 1, liquidity. You can buy or sell your investments in literally seconds. Need some quick cash? Just click sell and the money goes straight into your account. It's as easy as that. Something real estate can't compete with. Number 2, you don't need a high starting capital. You don't need $100,000 to start. But in this challenge, we do have it. But you can invest with $100, $50, or even $10. Fractional shares mean you can own pieces of Amazon or Tesla right now, today. Number 3, instant diversification. In a single index fund, like S&P 500, you can own a tiny piece of hundreds of different companies across dozens of industries. That kind of diversification in real estate will require millions of dollars and years of work, but you can do it in a couple of taps. Number 4, it's 100% passive. Buy an index fund, set up an automatic contribution, check in once a year, and that's it. No tenants, no repairs, no 11 p.m. calls at night. It runs itself. Number 5, tax advantaged accounts. 401ks, IRAs, Roth IRAs. These accounts let your money grow tax-free or tax-deferred. That's a massive long-term advantage that real estate simply doesn't have in the same way. And number 6, the power of compounding. When your investments grow and generate dividends, those get reinvested, and then they grow too. Over 20 or 30 years, that compounding effect is absolutely extraordinary. It's one of the most powerful forces in personal finance. But investing in the stock market has its dark sides too. Number 1, volatility. Markets can drop 30, 40, or even 50% in a bad year. If you're not mentally prepared for that, you will panic sell at the worst time possible and lock in those losses. Number 2, you have zero control. You own a tiny slice of a company, but you have no say in how it runs. Bad CEO, scandal, bad earnings, you just watch your portfolio drop and hope for the best. Number 3, it's intangible. For a lot of people, watching numbers on the screen go up and down doesn't feel like real wealth. There's psychological comfort in owning something physical that stocks can't replicate. And number 4, this emotional discipline is hard. The market rewards patience, but when things are crashing, every instinct tells you to get out. Most investors actually underperform the market because of emotional decision making. So we've heard both sides. Now let's go back to the original question. You have 100,000. The goal is $1 million by 2030. Which one actually gets you there? Let's run the numbers honestly. If you put 100,000 into the S&P 500 today, and it returns its historical average of around 10% per year, by 2030, you're sitting at roughly 170,000 to 180,000. Not bad, but nowhere near $1 million. Now let's say you take that same 100,000 and use it as a down payment on a $400,000 multifamily property. You rent out the units, tenants cover your mortgage, and the property appreciates at a conservative 6% per year. By 2030, that property is worth somewhere between $550,000 and $600,000. You refinance after 2 or 3 years, pull out the equity, and use it as a down payment on a second property. Now you got 2 assets appreciating simultaneously, both being paid down by tenants. And by 2030, your combined portfolio could realistically be pushing $900,000 to $1.1 million in total value. So the winner is real estate. Real estate wins, and it's not even close. But here's what I want you to take away from this. Real estate wins the race to $1 million, but it's not for everyone. It requires work, patience, and a high tolerance for stress. Stocks are simpler, more accessible, and still build serious wealth over time, just slower. The smartest move? Start with whichever one you actually stick with, because the worst investment is the one you panic out of in 6 months. If this video helped you see both sides more clearly, like the video and drop a comment below. It would really help me. Also, tell me which one you would choose with $100,000. I read every single comment. And if you're not subscribed yet, hit that button. Thank you for watching, and I'll see you in the next one.